Good morning. Welcome to December's investment update, Hunt for Yield. For those of you that joined in last month, we did briefly cover the strength in the stock markets that was happening in early November due to, a couple of things really: resolution of the US election and also the potential news that lots of vaccines are coming our way. And of course, as we've progressed through the month, there's been a second vaccine and we have programs that are getting rolled out. So hopefully, as we move into next year, we'll start to actually find a resolution to the problems of 2020, and 2021 can be a new year of opportunity and hope. One thing to highlight here, so here's the equity returns for the world stock market. I showed two things here. There's a market capitalization weighted index, so where larger companies get a larger weight in the calculation. That's the solid black line. Sorry, one sec. Okay, that's not someone calling me to tell me I'm on mute. No, I think I'm good. And the blue line there, which is an equal weighted index. So where smaller companies have a slightly higher weight and can come through. And what you've noticed, what you can see if you look carefully at the chart, is that market capitalization weighted indexes, so the larger ones, were already positive year to date prior to November, but equal weighted ones weren't, so they'd lagged still. And as November went on and markets went up, there was broad participation from all companies out there, and smaller companies had a little bit of catch up there. So we've had good news. We'll go through what it means in a minute, and equities have started to reflect that in the move there. Looking at fixed income, very interesting moves on the month for fixed income. We continue to see government bonds struggle to make any further gains from here. In fact, yields on government bonds rose slightly. Of course, with yields rising, that means that the price falls. So investors holding those bonds suffer a small loss as that happens. But for credit, investors in credit, they did very well. Investment grade credit, the darker dashed line there, had already been doing quite well and had recovered from the panic earlier on in the year. But last month saw a particularly strong catch up in the high yield market as high yield investors were paid off there. And you see that line moving quite higher. Very much there was a grab for yield in the market. I think people like ourselves who have been selling out of government bonds and investing in credit to secure higher yields and higher future returns. I think we're not the only people thinking that way, and the market as a whole saw rotation towards that sector. I want to touch and refresh everybody about how we look at valuation. So for equities are valued based on their ability over the long term to generate profits and cash flows. And we try and look through the peaks and troughs of the business cycle to come up with a normalized earnings number and really anchor our expectations of and valuation around that. And yes, this year has been poor for earnings. We've seen the solid line there reflect the losses of many companies, but it's remained positive. The consensus numbers, the little x's, consensus now expects us to get back to that trend line, not next year, but the year after. So that's a pretty quick recovery. And then consensus is then a little bit more optimistic and expects us to overshoot that. But really, we've based our base case scenario on reversion to that trend line for earnings. And so just want people to bear that in mind when we're talking about valuation. That valuation we're going to talk about encompasses a recovery. It assumes that earnings are going to get back to trend, and those companies that were having a tough time will revert to trend and start earning profits again. And when we look at some of the numbers and consider holding equities for 3 years, collecting those dividends, selling out after those 3 years to think about what kind of return we might get, we find that it's looking pretty stretched at the moment. So loud and clear, the valuation message that we get is that equities are expensive. Now, if you consider the consensus numbers, So if we recover to that trend and then start to progress from there, um, in a world where there's very little return from cash and very little return from government bonds, and investors are sort of forced to hunt for yielding credit, it's very conceivable that a recovering earnings scenario for the stock market allows for valuation multiples to stay elevated. Now, if you factor in that case, think about consensus earnings, a PE of 20, you can get 7% compound a year from those equity indices. We tend to feel that that's a strong set of assumptions, and you're already assuming that a lot of good stuff can happen. And to assume that valuation will remain elevated isn't something we like to do. So we normally think about that 16 times multiple as an average over what things have been through different points in time. We do have graphs on how that's traded through history, but equally the 18 number is possible. That's not too much of a stretch, but when you can start to look at that scenario, you're looking at very, very low, if any, returns from market capitalization weighted indices. And our asset allocation meeting this month focused quite a bit on that, and then on the business cycle, which I'm going to come on to in a minute, and also a conversation that came up about, well, but what about the opportunities we see at the individual stock level? Because as you know, it's not just the top-down work that we do when we set our asset allocation. We also take into account the views of all of our specialist teams who are there on the ground looking at the individual companies. And the reassuring thing that comes through from that work is there's actually quite a few investment ideas, not just the stocks that we currently hold, but stocks are sort of sitting on the bench waiting to get into portfolios, trying to earn their way and fight their way into the portfolio. So the teams are coming up with quite a few ideas, stocks that stand to recover, stocks where valuation is okay. So whilst it's true at the overall market level that the market's expensive, it is fair to say that we are confident that we can still pick stocks that can deliver positive and attractive returns. And when you combine that with the business cycle, which is one of a recovering economy, it leads us to be neutral on equities. So we don't want to go overweight on equities because of this valuation, but equally recognizing that the business cycle is in the favor of companies, and also that we can find good companies out there. We on balance come back to a neutral position there. And if we touch on the business cycle, I don't think I've shown this slide for a while, but it's relevant at the moment because we've recently moved from a grade 4 to grade 5. So this is very much subjective, but the things that we look at, the criteria, monetary conditions first and foremost. What is liquidity like? Liquidity is that euphemism for how much cash is being created and being available for corporations to tap into. We have very, very easy monetary policy. I mean, not only now, but the promises by the Federal Reserve, for example, to not raise interest rates almost regardless of what happens for the next few years. That change in the framework that I've discussed before, where they used to preempt the emergence of inflation. They used to look at, how many people are working? Is there any slack in the economy? Is there any signs that inflation's coming through? And they used to preempt the various data points that would indicate that inflation is about to pick up. What they've said now is that they're not going to do anything until they see the whites of its eyes. So until they see inflation explicitly in the data. And even then, they're going to allow it to run above target for a period of time to make up for, in their mind, the lost inflation of the past. So monetary conditions are definitely, accommodative. They're as sort of as easy as they can get, I would say. They've thrown everything at this. We also have fiscal support as well, which shouldn't be ignored. On economic growth, as we start to get these vaccines come through next year, that should lead to a pickup in economic growth. We already see it in the PMI numbers, those surveys that go out to companies. We know that we've improved versus earlier on in the year when we had complete shutdowns. Even though we've got a shutdown now, it's not as draconian as it was earlier on, and there's more business activity. Companies are allowed to operate, allowed to work. So we've got economic growth picking up. And if we think about inflation, it is starting to trough. It's pretty low because we haven't been spending at the moment. We've been in our houses. We've been restricted on what we can buy. But as we move through, that inflation number is starting to pick up. And you also saw break-evens in the US start to move up as expectations of inflation edged a little bit higher. So when we put all those three things together, we think we're in that early upturn part of the cycle. Traditionally, the things that you would own after after recession, after we've started to emerge from that, would be equities. It would be equities with a bit more of a value tilt. And, another piece of evidence there, we saw value start to work a little bit better in November as that started to come through. So that move from quality to value also is a data point that evidence is maybe we've moved from that 4 to the 5. And then looking down on traditionally how you would play the bond market in this situation, you would be cautious about duration. So duration is interest rate sensitivity of bonds. So what tends to happen is as investors see economic conditions improving, they start to look forward to a point where perhaps that monetary accommodation is no longer needed. Maybe interest rates would go up, and as a consequence, yields start to go up on bonds. I think that it is different this time in that the Fed has changed the way they set policy. So I think we're yet to see how that's going to turn out. But still, that's we observe that there. And also credit spreads tends to be the place you need to be, with credit spreads continuing to contract and come in. So putting this together, as I said, we have a neutral risk-taking stance on equities generally. And then in the bond area, we do favor credit over government bonds. And as you know, we've taken government bonds down to a pretty low level, recognizing the fact that will they be the diversifier that they have been in the past. So this month, we spent a lot of time looking at credit and the risks associated with various credit spreads. Here's the opportunity set within credit. So you can see UK gilts at the bottom there, practically zero return. I think it's less than 0.5% a year yield to maturity to purchase a 10-year or even a 15-year gilt at this point. If you move into credit, so A-grade credit, the most secure credit out there, you start to earn 1%, 1.5%. If you move to triple B, so that investment grade credit that's on the edge of high yield but still in investment grade, you can get 2%, and then up in high yield you can get 4.5% roughly, let's say. Now, just expanding this chart out, and apologies, I should have kept the colors of the lines the same, but a little bit of an oversight there. I want to look at longer history here. And in particular, I want to look at the 2003 to 2006 time period. Back in the year 2000, we had a lot of money and debt accumulated that was spent on technology investments, companies that in the fullness of time proved to be bad investments, but that debt was racked up there. We had a lot of money spent by telecom companies. They spent that on, well, it wasn't 3G licensing, it was 2G licenses. So government sold the spectrum so they can operate mobile phones and do data. Exorbitant amounts of money were spent by all of the European telecom companies, Deutsche Telekom, France Telecom, to the point where they stretched those balance sheets in a very, very severe way. Equally, the amount of fiber optic cable that was sunk into the ground, all paid for by debt again, didn't get the returns that it needed to sort of pay off that debt. So we had a situation where there was concern in the high yield market. Could that debt be paid back? And over time, they started to raise equity. Companies started to focus on paying that debt back, and credit spreads started to come in, and they sort of normalized and came down by 2003, which is when the equity market turned around. But the really interesting thing here is that those spreads continued to move lower, which means prices went higher for 3 years after that. So whilst we had very easy monetary policy and access to finance by companies, spreads came down, and they got actually, high yield got just to above 2% there. So it got quite low. So looking at the historic precedent from where we are, if you keep monetary policy accommodative for a very, very long period of time, you start to, in market terms, what's happened before is you've seen continued pressure on credit spreads, and it's been a good place to invest. Now, it also builds up longer term risks. As we know, following that long period of easy money and access to debt, we then had the great financial crisis, as too much of that money was invested in houses. So the longer we do this for, the greater the risk that the money is invested in foolish endeavors that aren't going to pay off the bondholders eventually. But there's this period of time, and we're just at the start of it right now. So the question is, okay, how long might this go on for, and what kind of risks would we run? What do we need to look out for in order to become concerned about some of these asset classes? So very much we spent the meeting looking at some of these risks. So looking at A-grade credit, so the most secure investment grade credit out there. Here you can see how those spread. So this is the extra return you get from taking credit risk above government bonds. And at the moment, it's pretty low. It's down to that 1% level. But the all-time low is even lower. So it's about 0.6%. So scope for that to fall further. Now, the graph below shows, well, how much of a rising yields would we need to wipe out a year's worth of return? And it's actually pretty slim at this point because yields are so low to start with. So it only needs a 15 basis points, so 0.15% rise in yields in order to wipe out a year's return. So there could be a bit of volatility in the returns we get from this asset class, not because the companies will default. So default risk is very, very low here, but it's just the risk that investors might demand a higher return at some point, in which case prices would fall. So it's that market risk of the credit spread there. Looking at triple B credit, you can see you get a higher yield from triple B. It's currently just above 1.5%. Again, scope for that to narrow. Historically, it's hit 1% in the past, so it could do that again. It's not necessary to say that this is our central expectation that we're going to go down to that level, but it's just using history and the data of history to give us a guide to what might happen, and then think about the risks of holding this at the moment. So here, 20 basis points, so 0.2% rise in credit spreads. If investors were to demand more return, that would wipe out your year's return from credit here at the moment. And then looking at high yield, here we get more returns from high yield, just above 4% there on the yield to maturity. And these tend to be shorter bonds as well, so they're very much less exposed to general interest rate risk. And that feeds in their favor in that it actually takes a 1.2% rise in yields in order to undo a year's worth of return. So ironically, you sort of come away from this with actually a little bit more comfort about those high yielding bonds as a place to be. There's the extra return you get gives you a bit of a cushion for some of the losses that might happen were credit spreads to widen. Now, as I said, the most likely course of direction from here is that credit spreads continue to tighten because people aren't getting any return from cash, they aren't getting any return from government bonds, and there's substantial risk in the longer term from those government bonds. So I think investors like we are looking at high yield as a way to generate some good returns, but we've always got to be focused on the risks. So that's a lot of the work we did this month. So in summary there, low government bonds have really forced and continue to force investors into the credit spectrum and into equities, I would say, pushing down yields. But based on previous cycles, there is scope for those yields to compress further and hence for price to rise. High yield probably gives you the biggest cushion against an unexpected increase in yield there. Admittedly, high yield is the asset class that can have larger increases in yield, but for small volatility purposes, it's got a bit more of a cushion. It's important to be aware of the risks there. And on balance, with an improving economy, with continued support from the monetary side, and the business cycle in its favor, equities should be well placed to do okay despite the valuation headwinds that they have in their favor. And I think picking good stocks and making sure that you're in safe bonds, but attractive bonds from a yield perspective, managing that cash bond ladder that we've put in place to ensure that we've got bonds rolling off and good access to liquidity there. All seems sensible things to do. And of course, that's what we try and do. We try and do sensible things based on our analysis of the data. So looking at the portfolio now, this is a cautious portfolio, which is roughly 50% bonds, 50% equities. So it gives a good view for the family of funds and portfolios that we run. You can see at the top are still holding the index-linked government bond, but that's now down to about 1%, and a lot of that weight has been reinvested in corporate bonds and high-yielding bonds there. So we're owning a lot more different names. We've increased the diversification. If you look at the kind of maturity dates there, you'll see quite a few 2022 bonds, 2023 bonds, 2024 bonds that mature in that kind of ladder fashion as we go through time. So and of course, if you hold the bond to maturity, the return you get is very much the yield to maturity that you bought it for. So you start to get a bit more certainty about the return that you're likely to get there. On the equity side, a good spread of businesses, some businesses in the UK, a mixture there of large cap businesses exposed to the general global economy, things like Unilever, things like Relex, Prudential, obviously with an Asian exposure there, but then some domestic companies with the scope to improve as the economy comes back on stream, notably Howden and Taylor Wimpey, and also Intercontinental Hotels. In Europe, a reasonable amount allocated to Europe now. Some healthcare companies there, some beverage companies there, and then in North America, it's fair to say, if you look at how we're positioned versus the makeup of global stock markets, because the US has done so well for such a long period of time. I mean, the US market has really outperformed for about 10 years now. The US market makes up about 60% of the global stock market. So in this sense, we have a lower exposure. We're more diversified geographically than that broad market cap weighted index would be. And a few investments in emerging markets there through Tencent and Alibaba. Sorry, probably just gone through the whole portfolio there, but I like what we hold. Trading activity in November. So in October, we started to sell our government bonds and implement our bond ladder. We continued to do that in November. So a few of the trades you'll see here, November 5, we bought 3 bonds there. BP, which we haven't quite got the conviction in BP to invest in the equity. That business is going through quite a transformation to move away from drilling hydrocarbons to renewable energy. Something we're looking at and we're interested in. But one thing we are very confident on is that company has broad support from the market, and its bonds are, I think, very, very good bonds. So we purchased some BP bonds there. Ford, used for financing motor loans. Ford is, things are improving there for Ford as well. Our fixed income team's done a lot of work on that credit to understand the risks there. And that's an attractive bond that matures in 2022. And then Irish Life bond there as well. So a European company there based in Ireland, again, 2024 bond. Then in November the 9th, we took advantage. We've been watching electronic arts for a long time, at least seriously for about three or 4 months. We've identified it as a well-run company with good access to the gaming market. It can be quite volatile. It had been sort of above our estimate of fair value. In November, they announced a few delays in some of the games when they would be released to the market, and with the euphoria elsewhere, people took the chance, I guess, to rotate out of electronic arts and use that as a reason to sell it down and buy some other things. For us, it was a really great opportunity to get into the stock and buy that as it was sort of neglected by other investors. So we established a position in electronic arts. And we also added to Becton Dickinson, a US healthcare company that runs a lot of the machines that do the intravenous drips that you will see beside hospital beds. So that was already a position we had, but we built that up. It had lagged some of the recent recovery as well. Then a little bit later, we bought another bond, continuing to build that bond ladder out. As things like Diageo, the spirits maker, was really, really strong in November. So we sold that based on valuation as it moved past our target price. And then later on, we added AB InBev. Now, Anheuser-Busch is a company that we've been a little bit wary of previously because it's got a fair amount of debt on the balance sheet. But it's one where there's a good scope for it to recovery, and it's kind of in that value bucket. You may have heard before talk about value versus growth and how value's been quite cheap. There's a lot of scope here as the economy comes back on stream for AB InBev to recover and for that stock price to rise quite materially. We've been very impressed with how they've managed their operating margin during this time. I mean, if you think about a business where large amounts of your sales are suddenly cut off, and your business model is very much to produce beer but be very, very keen on costs, suddenly having that revenue line change but being able to change your cost base as well very rapidly is very, very impressive for us. So we were glad to add that into the portfolio and change our exposure slightly so that we've got a bit more of an opportunity to participate as economies recover there. Performance-wise, really, really good month, driven by equities. You can see the return that we got from the equities we held was about 9.7% there. In the cautious fund, roughly it's about half equities, so 9.7 gets halved roughly to about 4.6 contribution to the cautious fund's overall return. Where did it come from? Well, the UK was very strong. We'll go into those names on the next slide. So we made our UK holdings rose 16%, but also our property and our infrastructure contributed as well. So our holdings in Grainger and Unite and Digital Realty on average were up 7.2%, and our holdings in infrastructure, which partly benefited from Biden's victory and the US's commitment to invest in infrastructure as part of the stimulus bill that they're likely to introduce. Within fixed income, as I mentioned, there was this grab for high yielding paper and for credit in the month, and our holdings really benefited from that. So the high yield bonds that we own were up 5.1%, so very, very strong return for those bonds in the month. And our investment grade bonds not too far behind, up 3.2% there, so giving a good contribution. Government bonds were weak, but we don't really have very many of those, so it's not really a drag on our portfolio. And I guess the only real weakness in the month was our commodities holding, which is clearly our gold position. So our thinking on gold is very much unchanged. As I've said before, if gold does have a meaningful pullback, then it's likely because we're making a lot of money on our equity position, and that's definitely come through this month. I think our view on gold is very much with the longer term time horizon in place. It's in there structurally to help the portfolio under some of the situations that may evolve down the road. So it's not necessarily in there for short-term tactical trading, which I know a lot of people do use it for. Now, if you have a short-term view, your outlook would be one of, well, the economy is going to improve, so that might mean that less stimulus is needed. Do I still need to hold my risk off safety asset if it's safe to go back in the water? And a lot of people would have, yes, took profits and sold on that basis. But when we think about the longer term evolution of what's going to happen here with continued very, very accommodative monetary policy, and that risk of inflation eventually starting to creep in a little bit, what happens there becomes very uncertain, because investors at the moment are looking at government bonds and they're saying, okay, well, government bond yields will rise as inflation starts to move higher. But there's a fair chance that that doesn't happen this time, because those government bond yields can only start to rise if the Federal Reserve is willing to let them rise. But what they've said is that they are going to keep interest rates low for a long period of time, regardless of what happens with inflation. And in fact, they're going to let inflation run hot, which would mean effectively more monetary printing. So a few years down the line, we get into this situation where I think there's really a question on, well, how does this monetary policy framework work? And in that situation, that inflation shock that might come in there, gold is one of the assets that will provide the portfolio a cushion from that volatility. So we have tried to make all our capital work as hard as possible. So we've taken a meaningful amount out of government bonds to get that work in hiring credit, but we want to make sure that we've got risks controlled. And the question I ask myself when I look at this table is, okay, we lost 0.5% of return because of that holding in government bonds in a month where we were up 5.5% overall. Is that a reasonable sacrifice of return to make, given the defensive capabilities and volatility managing potential that it has down the road? And I think the answer to yes is yes to that. So the question really is that, is the position sized in the right way, and is it still doing what we want it to do? The answer which would be yes. So a good month, 5.4% for the cautious portfolio there, or 5.6 actually on the NAV. So yeah, good month. Looking a little bit more detail in the individual names, a number of those bonds that we've got very, very strong on the month. So looking in the high yield bucket that we've got there on the bottom right, Barclays and GKN up 8%, 7.87 for GKN, 8.5 basically for Barclays, which is a CoCo bond, a contingent liability bond that if Barclays were to get into a distressed position would convert into equity. But equally, Rolls-Royce recovering there, and our very, very short dated AA bond benefiting from potential takeover of AA by private equity. Those bonds have a provision in there which, if the company is taken over with a change of control, they are bought out at 101, I believe. So a bit more to go from that as well. On investment grade, a number of bonds, they're returning 4 or 5% as investors were really desperately buying these things in the month. And then on the infrastructure side, really, really strong move, up 18%, nearly 19% from Unite Group, student property. Looking forward to a year where students can go to university without having to worry too much about COVID because vaccines are in place. On the equity side, Taylor Wimpey, definitely the standout there, up 45% on the month. That's a company which has had a volatile journey, but it's always been one we've had a lot of conviction in. It's got net cash on the balance sheet. It's well managed and able to build even at the moment with current restrictions, and we see continued demand for houses, and the housing market is well supported. So that asset worth a lot more, and more upside I think on that as well. So can we continue to hold that despite the strong returns there, because we think there's more to come. Booking, Heineken, both benefiting from the resumption, the resumption of the economy next year, so that expectation that things are going to start to get back to normal. We have reduced the weight that we've got in Booking. It used to be one of our largest positions, but the price of that stock now is at a level where it is basically where it was pre-pandemic. So before we knew about COVID whatsoever, Booking share price is back to that level. And we have to recognize that there's still a few bumps that are going to have in the road, and a few questions as well about, will business travel go back to what it was? Clearly Booking is more exposed to European and leisure travel than business necessarily, but still a meaningful way in that portfolio and a really, really great asset there. Things that were a little bit weaker tended to be either companies that had done very well in the month previously, or companies where they have a more of a defensive tilt to it and were left behind. The exception being Alibaba, which is still suffering from the fallout of the pulled IPO of Ant Financial. Our view on this is very much that this is a really, really good business. Forget about the Ant Financial part, but the core business is really, really essential. It facilitates e-commerce and commerce in China. It's a big part of that Chinese economy, making that happen. And what if we think about what's going to happen next year, that potential of the US dollar weakness that I've talked about, that rebalancing of trade, although the US trade numbers were off the chart recently, so that deficit is still there and still very large. But Chinese companies should be selling to Chinese people, and Chinese people should be benefiting from the fruits of their labor. Alibaba definitely helps facilitate that, and is deeply embedded in any infrastructure there. Now, a lot of times these tech companies, they can have a wobble when there's concerns, and that tends to be the best time to get in. We've done that before with Google. We've done that before with Facebook, when Facebook was suffering from the Cambridge Analytica fallout. And equally with Google, when people questioned whether Google could transition to mobile. So we see that, yes, there are some concerns at the moment about Alibaba, but for us, that's an opportunity to build a stake in the business, and to hold on to that. And in a couple of years' time, when that's washed through, we should find ourselves with good profits from that holding as well. Okay, as I mentioned, if anyone's got any questions, please feel free to put them in the Q&A box, and we'll go through those at the end. I'm just going to go through a couple of these performance graphs now, and maybe talk about, we haven't quite got talk about the year, November to November. So the defensive fund now has 12 months of track record, so we're allowed to show these pictures. Over the last 12 months, the fund is up just shy of 6%, which is pretty good, all things considered, I think. Again, our philosophy here is that if we can deliver our strategic asset allocation, or even improve on that, then that should be enough to help us beat the competition and deliver really, really good outcomes. So in the 1 year that we're looking at here, the fund's up 6%, our strategic asset allocations up about 4.5%, and the peer group's up about 2.7%. So kind of all on track there, as you would expect. If we look at a cautious model, the cautious fund, the return over the last year has been 5.66%. So good return there. Again, ahead of our strategic asset allocation, which is up 4.19%. And this is ahead of the peer group, which is up 2.74. So very much delivering what we wanted to do there. Looking at the balanced fund, a little bit disappointing here. So our fund is up 3.76%, which is basically in line with our strategic asset allocation. So a little bit of disappointment there. And currently that's below or behind the peer group. But again, this is a 1 year number, it's a short-term number. If we look at the 3 year numbers there, you can see that our strategic asset allocation has historically beaten the peer group by a considerable margin. And on a 5 year basis, it's beaten the peer group as well. So whilst at the moment the peer group seems to have edged away slightly, I think if you look at the equity market in particular, there are a number of kind of momentum stocks where valuation has been pushed and extended, and people have really chased a small number of stocks which have driven some of the index returns. I think that's what's responsible for the peer group's short-term beat of our strategic asset allocation, but we continue to back our process and expect our strategic asset allocation, and indeed the extra work we do with our tactical asset allocation, our stock selection, to beat that in the long run, as it has done historically here. Growth model, 1 year we're up 4.14%. So again, all these things are really amazing given what we've been through to be talking about positive returns on this year. But up 4.14% versus the strategic asset allocation at 3%. Again, the peer group slightly more ahead because of that phenomenon I talked about with people chasing these momentum stocks at the moment. But as the longer term figures show, over the long term, our strategic asset allocation delivers, and our fund has delivered on top of that. So all on track, basically. Okay, I will move to Q&A now and see what questions we've got. Okay, I'll stop sharing as well. There we go. Okay, one question. So the question is, what do you think will happen during January in markets, given previous years it generally rises? And what should those do with cash to invest? It's a question mark. Okay. So investing new cash, as I've said before, that the best thing you can do is have a plan, right? Have a plan that not only deals with what happens if things go in your favor in the plan, but also what happens if things go against you on the plan. Um, I'm not sure what options you have in how you would invest. I guess what I would say is invest the bond component first. So if you think about what is likely to happen with credit spreads and that continuing tightening, I think the risk of waiting for a correction in credit spreads is not worth taking. So you might as well invest the bond component first, and then if dollar averaging in on the equities makes you more comfortable, then that's something that can also make sense. I mean, January, it's possible that there's a sort of correction in January as people, assess the year of 2021. But as it unfolds with the rollout of the vaccines, it's likely to have just a wall of positive news flow. So I think, factor that into your plan. Yeah. Second question, do you still have faith in gold bearing how much it's lost recently? It's pulled back a lot recently, that's fair to say. We always said gold would be a volatile asset. So in terms of being a safe haven asset, gold doesn't have any credit risk associated with it. That would probably be, it doesn't have any counterparty or credit risk. I caveat the counterparty with depending on how you hold it, but the credit risk is the important thing. So it doesn't have credit risk to governments. And obviously governments always pay their bonds back, but they tend to do so with depreciated money as they just print the money to pay it back. So gold protects you from that, but it also doesn't have any credit risk. And one of the things that we've done in the portfolio is we have increased our credit risk that we're taking. So, in those sense, it's still a good asset from that point of view. It's lost a little bit recently, but it's gained a lot over the last year. So it depends on what time frame you look at, really. The way I look at the how it's behaved, it's on an upwards trajectory with the kind of volatility you would expect. So the pullback that it's had is in line with how you would expect that asset to trade. We are about to go through a process over the next few years of understanding how average inflation targeting works. And as we do that, I think people will look to gold to cushion their portfolios and be a part of their investment solution. So yes, I still have faith in gold. Another question. Can you explain how a company such as Barclays can be high yield and not investment grade? That's an excellent question. So there's a difference between a company being rated and its bonds being rated. So you can issue different types of bonds that rank above each other. So some bonds get paid out first, and then other bonds get paid out later on in the event of a company being wound up. And it's called sort of the capital structure. So at the top you have the most senior bonds secured maybe with specific bits of collateral, buildings that would be sold off in order to pay those holders back. As you move down, you get to sort of junior bonds that get paid afterwards. Then you get subordinated bonds that kind of get paid last. And then you get to contingent sort of hybrid capital, so contingent convertible bonds, or CoCos as they're called, which those bonds, they might, instead of being paid back under certain circumstances, they can be converted to equity. And then at the bottom of the pile of the capital structure, you have equity. So equity is the people that take the losses first. So a company can be a really, really solid company and can be investment grade, but if it issues bonds which can convert into equities, then those can be considered higher yield because they're further down the capital spectrum. So that's that. What's our view on the Brexit decision impacting markets? Currently, a deal still looks a long way off. Yeah, so Brexit has been sort of rattling on in the background for 4 years now. And everybody, I think, would appreciate just getting some clarity on it, really. As I've said before, We don't really have any insight as to what the deal is going to look like. It sort of confuses me that we seem to be arguing about sort of how much fish we allow the French to steal from our fishing waters, which, I mean, if that's the sticking point, you know, I'd like to think we can get past that, because fishing's not a huge part of our economy generally. But I, you know, understand that negotiations can be, you know, painful on all these things. Yeah, it currently looks like a no deal situation might be there. I mean, I would classify a no deal as we adopt World Trade Organization rules with the opportunity in the future to strike another deal. So it's not like a one point event. It's okay, this is what we're going to do from now. Everybody gear your business towards that. And then we're going to go back to the table, and we're going to negotiate other things in the future. So even a no deal is still an agreement in the present with the possibility of a future deal down the line. So I guess I'm just a lot more positive on that than maybe other people would be. And definitely all of the companies can, if you tell them what the rules are going to be, you know, don't fill out that form, you fill out this form instead, or you, instead of filling out the one form, you fill out the 5 forms. Because that's kind of what these things generally come down to. You know, again, if they know what the rules are, they can adapt their business. It may be that some businesses decide to cease doing what they're doing because that regulation that's being put on them is too onerous. But hopefully it just gets resolved. I think it's that uncertainty that really sort of annoys investors and has caused some people to avoid the UK just so they don't have to deal with it. I mean, we have a few domestic businesses that would be, you know, everything would be affected by it in a little way, but I think the businesses that we've got are very able to deal with whatever comes down the pipe. Okay, that's all the questions. Well, thanks for joining and listening. I hope everyone enjoys the festive season, has a really happy holiday, you know, really good time to spend time with your families, and I will see you next year. So wish everyone a happy new year, and I look forward to January's edition. Goodbye.